Welcome back to another taping of Questions with Matt and Mark. So this week, why don't you go ahead and start? You want to ask a question?
So with crazy stuff going on in the oil markets, can oil prices actually go negative?
They technically can on a short-term basis. So what happens, viewers, is futures are traded on the Chicago Mercantile Exchange, and they're all contracts based upon the month. And because of the slowdown due to COVID, it has caused a lot of excess supply. And what has occurred is there's not many places to store this oil, Mark. So what has happened is this front contract actually went negative because people were not able to take delivery, and prices on a temporary basis actually went negative. And if you though look at forward contracts multiple years out, the price right now is a lot higher, as you can imagine.
Right.
Okay?
Yeah.
So the question I have for you is, there's been a lot of talk about the Federal Reserve and things that they've been doing in the marketplace since the COVID situation. Just explain maybe to viewers, what is the Federal Reserve and what do they do?
Yeah, so the Federal Reserve, they maintain liquidity in our markets pretty much. They want to make sure that everything is functioning properly in the financial system. So the Fed has two mandates that they're required to fulfill. Number one is maintaining maximum employment, and number two is the stabilization of prices. So I won't get into all of the tools that the Fed has at their disposal to do those two things, but they will deploy those tools as necessary to fulfill those two mandates that they have.
That's a good way to explain it. You might hear in the news a lot, they use the term dual mandate.
Right.
And so Mark just explained to you what those two things are. That's excellent. So we'll be back next week with another episode of Questions with Mark and Matt.
And Lewis.
And Lewis. And we'll see you guys soon. Take care.